He is. Mark Coan, founder of Money Sherpa, regular guest on the show. He's back with us. Good morning, Mark.
Morning, Greg.
Right, we're being told it's not the same. We're being told that the main banks are well-resourced, they're going to be well-protected, but yet here we are seeing some of the medium, smaller-sized banks going to the wall, and people with a financial interest in this by way of shares and what have you are rattled. Are you rattled?
I'm not rattled, and I'm not particularly surprised, actually. As interest rates rise, that turns up the pressure on the whole financial system. We've had kind of 15 years where everybody's got used, ourselves as consumers, but also the banks, to a low interest rate environment. As the pressure has turned up with higher interest rates, then a few things have started to go pop. And the big question that's kind of spooking the markets is whether this is just the system blowing off steam or whether the whole thing is about to go kaboom. And I think really both of the cases that triggered these issues, Silicon Valley Bank in the US and Credit Suisse, the big Swiss multinational bank, did have some unique circumstances behind them. And I think it is important to remember that. Silicon Valley Bank, the US regulations were repealed only, I think it was 3 or 4 years ago under the Trump government, for what they call small banks. So small banks are under $250 billion US. So they're big in an Irish context, but these are the regional banks. And to be honest, in my view, if that regulation hadn't been repealed, and that regulation exists in our banks, for example, we are subject to stress testing and a lot of other things, the situation in Silicon Valley Bank wouldn't have happened. So that was a Trump deregulation that created this unique scenario.
Why are the officials in the United States and ours in Europe here continuing with this policy of raising interest rates when it's not seemingly yet having the result of lower inflation, but it is creating this uncertainty and threat to banks, for example?
Yeah, it's a great question, Greg. And to be honest, it's because it's the only lever that they've got. I mean, really, over the history of controlling inflation, which has been generally successful since inflation was tamed back in the 80s, then central banks have used this lever very successfully. If you flip the question and say, well, if interest rates aren't going to control inflation, then we really would be entering unknown territory. And I think that's why central banks are persisting. So they're basically saying it's not happened yet, but if we get to the right level of interest rates, we will tame inflation. And that is, let's be clear, that is really fundamental for a successful economy. So it's a really important prize. And I think the calculation that central banks are making, they know they're going to blow up some things in the banking system by hiking interest rates so far and so fast. But they're hoping that they can go around sticking plasters on those things as they blow, and limit the damage. What we can say with a great deal of certainty is that there is a lot more regulation, a lot more. The amount of capital that the banks hold has changed significantly. And plus, I think it is important to say to your listeners, the bank guarantee scheme is in place. These are things that weren't in place back in 2008.
People are very motivated to look after their money, and they're not getting clearly the assurances that they need.
Yeah, there's a huge amount of fear. And I'll go back to that comment I made earlier on. Banking is a fragile business model. We do need it otherwise, for liquidity and for the whole economy to work. But fundamentally, banks loan out more than they have in the deposits. In any other area of the economy, that wouldn't be a valid business plan, which is the irony of it being a bank. But that is the reality of the banking system. So it does spook people when we get near to the limits, and that's where we are.
Generally speaking, are we in a period of shall we, shan't we fix rates if the options are there, or where are we at in terms of all of that, Mark? Because we haven't spoken for a while.
Yeah, so it's still, I would really encourage people. So basically, if inflation stays high, then interest rates are going to stay high for a long time. So I think the latest developments really make those people who may be on the edge of thinking about fixing, hoping that things might come back down. I think it makes it unlikely that interest rates are going to come down, these latest developments that we've just been talking about. And I guess the chink of light is the fixed rates still are quite competitive. I do not think that's going to last for long.
What's out there, Mark?
Yeah, so you can fix around 3.2, 3.3, and, the average tracker now is at 4.65. So, and the average variable rate is we've already seen variable rates start to rise. AIB last week increased their variable rates. They're the first of the banks to increase their variable rates. So really, if you can fix, I would encourage it.
Surely it would be in a bank's interest to give a person who maybe has cash flow issues the best possible deal for them to meet the repayments, rather than leave them at the whim of the markets and end up having a mortgage that they can't afford to pay, and then the bank has to go through the process of repossession. Where is the logic there?
Yeah, I think it's different. It's different for different cases, and I think there are three broad groups that there are within the vulture funds. So there are the people who are currently in arrears, and there isn't really any options for them because no other lenders will take them. There are the people at the top of the scale who actually, because they've heard vulture funds and mortgage prisoners, we are finding there's quite a lot of people who actually can switch to what we call an open market lender and think they can't. And I am trying to get the message out, and a number of us are, that actually do check out whether you have an option. And then there's a group of people in the middle who currently won't pass the affordability test. So they're not in arrears, but let's say maybe their income's been reduced, they may have got divorced, circumstances have changed, and they can't pass the affordability tests. And I do think there is a case for lenders and government to look at that group to see, exactly to your point, Greg, to see if things can be done, because it doesn't seem to make any sense.
So there are different trackers. Are there trackers with a premium, let me put it like that there? And can anyone on a tracker, if they're not in arrears or whatever, fix their mortgage with I'm not on about sort of the main lenders, if you know what I mean? Because the couple of contacts I had were people from main Irish banks. Not that there's many left, but you know what I mean.
Great question. So trackers actually track, they all have a margin. So they're all higher than the ECB rate. So the best trackers, the lowest margin trackers, are 0.5. So, but they do go up to 2.5. Actually, I think I have come across the odd one that's +3. So then you take the 3.5 and you add, let's say, 0.5, and then you're paying 4. So that's somebody on a 0.5% tracker. The average tracker in Ireland actually is at +1.15. So the average person on a tracker is actually paying 4.65. So ECB rates.
How things have changed. Yeah.
Yeah. And it's now 4.65. To your second question, Greg, everyone, if they pass the affordability tests, every tracker customer should be able to fix.
Right. Okay. And that they should be, depending on the bank, they might be able to avail of a fix lower than their current tracker rate then.
Yeah. So there's two things that I say to tracker mortgage customers right now. Number one, ask for your mortgage offer letter from your bank. That'll tell you what rates you can fix on. And then number two, talk to a mortgage broker to see if you'd be better off switching and actually fixing with another lender. Because on average, it's 10,650 euros cheaper over your mortgage term if you switch and fix. You typically find the big banks have the least attractive rates, and there are some newer banks and lenders who are offering better fixed rates. So, so get your offer letter, check out what you can get, and then talk to a broker. That would be my advice.
All right, and you can go onto the internet and type in Money Sherpa